The people who don't own Bitcoin are about to hit a purchasing power wall so hard that the impact will ripple through their entire financial life. I'm talking about millions of regular folks who spent the last decade listening to financial experts tell them to just save more and diversify their portfolio. And I'm not talking about a small group of unfortunate investors here. I'm talking about roughly half of all savers, tens of millions of people who are diligently putting money into accounts that are silently losing value every single day. The dollar has already lost more than 90% of its purchasing power since 1971, which means the clock has been ticking for a long time. And here's what nobody's saying out loud. This isn't just about inflation numbers. It's about the complete destruction of your ability to preserve wealth. I'm going to walk you through exactly how we got here, why the systems we built to protect wealth are failing, and what this means for you. Whether you're someone who's been skeptical of Bitcoin or someone who's about to watch your savings evaporate in real time, because once you understand the incentive structures that created this mess, you'll see why Bitcoin was basically inevitable. So here's the model I want you to keep in your head. Think of wealth preservation like a three-pillar system. That's the metaphor financial experts have used for decades. One pillar is cash savings. One pillar is traditional investments, like stocks and bonds. One pillar is income from work or business. The idea was that if you had all three, you'd have financial security, stability, the ability to retire, right? Except here's what actually happened. We sawed off two of the pillars, set fire to the third one, and then acted surprised when people's wealth started disappearing. Let me show you the numbers because this is where it gets really interesting. According to the Federal Reserve's own data, the dollar has lost more than 97% of its purchasing power since the Federal Reserve was created in 1913. Now, you might be thinking, okay, 97%? That was over 100 years ago. But let's do the math on what that actually means in recent years. If you had $100,000 in a savings account in 2000, that money could buy you what $182,000 buys today. That's a 45% loss in purchasing power in just over 20 years. And that's using the government's official inflation numbers, which everyone knows are understated. If you use the actual cost increases for things regular people buy, housing, healthcare, education, food, the real inflation rate has been much higher. Now, this is where most people say, well, that's what the stock market is for. Stocks beat inflation. And yes, technically that's true on paper. The S&P 500 has returned about 10% annually over the long term. But here's the part they don't tell you. First, you have to actually be invested in the market. Most people keep a significant portion of their wealth in cash because they need liquidity or they're scared of volatility. Second, those returns are before taxes. You pay taxes on capital gains and dividends every year. Third, and this is the big one, you have to survive the sequence of return risk. If the market crashes right before you need the money, you're forced to sell at the bottom, locking in losses that can take decades to recover from. And fourth, even if you do everything right, your real returns after inflation and taxes are often much smaller than the nominal numbers suggest. Now, here's the first pillar we saw off: cash savings. The entire concept of saving money in a bank account is based on the idea that money holds its value over time. But that hasn't been true for decades. Every year, the money in your savings account buys less. It's a slow, silent theft that most people don't notice until it's too late. The banks pay you maybe 1 or 2% interest, while inflation is running at 5, 7, sometimes 10%. You're literally paying the bank to hold your money while it loses value. And the incentive structure here is totally broken. Banks make money by lending out your deposits at much higher rates than they pay you. They have zero incentive to protect your purchasing power. Their incentive is to keep you in the system, extracting fees and interest spreads, while your wealth slowly evaporates. Now, the second pillar, traditional investments. The entire stock and bond market is built on the assumption that companies will continue to grow and governments will keep their promises about paying back debt. But here's the problem. Companies are dealing with the same inflation pressures that you are. Their costs are going up, their profit margins are getting squeezed. And when the money supply expands rapidly, asset prices become disconnected from reality. We saw this in 2008 with the housing bubble. We saw it in 2000 with the dot-com bubble. We're seeing it now with everything from real estate to stocks. The problem is that when you invest in these traditional assets, you're not just betting on the underlying business or asset. You're betting that the financial system itself won't break down. And as we saw with the banking crisis in 2003, that's not a safe bet anymore. Now, let's talk about the third pillar, income. This is where things get really interesting. Real wages, adjusted for inflation, have been basically flat since the 1970s. Productivity went up, corporate profits went up, Executive compensation went way up, but the actual purchasing power of the median worker's paycheck stayed the same, which means that while the cost of housing, healthcare, and education all exploded, people's ability to save and build wealth did not keep pace. The classic advice was to save 10 to 15% of your income. But if you're making $50,000 a year and your rent is $2,000 a month, your student loans are $400 a month, your car payment is $300, your health insurance is $200, and you're trying to feed a family, where exactly is that 10% supposed to come from? The math doesn't work. And yet, financial advisors kept giving the same advice because their incentives weren't aligned with helping you. They were aligned with managing assets. The more money you put into investable accounts, the more fees they collect. They don't get paid to tell you that the system is broken. They get paid to keep you in the system. This brings us to the psychological shift that nobody talks about. Most people grew up in a world where money was relatively stable. You could work for 40 years, save some money, and retire with dignity. The social contract was clear. Work hard, play by the rules, and your money will hold its value. So they internalized that belief structure. They didn't question it because for most of their lives, it seemed to work. But then slowly, quietly, every piece of that social contract got renegotiated without their input. Inflation became the norm. Wages stagnated. Asset prices disconnected from reality. And instead of recognizing that the system had changed, a lot of people kept acting like the old rules still applied. They kept thinking, if I just save a little more, if I just diversify a little better, it'll all work out. But it didn't. And now they're watching their savings accounts lose value every year while the cost of living keeps going up. Now you're asking yourself, okay, but what about Bitcoin? Isn't that just another speculative asset? And that's a fair question. But here's where Bitcoin is fundamentally different from everything else. Bitcoin has a fixed supply of 21 million coins. That number is programmed into the software and can never be changed. No government, no central bank, no corporation can create more Bitcoin. It's the first time in human history that we've had a form of money with absolutely predictable, immutable scarcity. Think about that for a second. Every other form of money, gold, dollars, euros, yen, has a supply that can and does increase. Governments can print more dollars. Mining companies can dig up more gold. But Bitcoin is different. There will only ever be 21 million, and we know exactly when each new Bitcoin will be created. The last Bitcoin will be mined in the year 2140. This is why Bitcoin is called digital gold. Like gold, it's scarce. Unlike gold, it's easy to store, easy to transport, and impossible to counterfeit. But here's what makes Bitcoin even more powerful than gold. Its supply increases at a predictable rate that cuts in half every 4 years. This is called the halving. In 2000, the reward for mining new Bitcoin was cut from 12.5 to 6.25. In 2004, it was cut again to 3.125. By 2018, it will be 1.5625. This means that while demand for Bitcoin has been growing exponentially, as more individuals, companies, and even countries adopt it, the new supply entering the market is decreasing. This is basic supply and demand economics. When demand goes up and supply goes down, price goes up. And this isn't theoretical. We've seen it happen 3 times already. After each halving, Bitcoin has gone on to reach new all-time highs. Now, let me be clear about something. I'm not telling you to put all your money into Bitcoin tomorrow. That would be reckless. But I am telling you that if you have 0 Bitcoin, you are exposing yourself to a massive risk that most people don't even see coming. The risk isn't that Bitcoin goes to 0. The risk is that the dollar continues to lose purchasing power at an accelerating rate while you hold all your wealth in a system that's designed to debase that wealth. Here's a concrete scenario. Let's call him Mark. Mark is 45. He's worked as a software engineer for 20 years. He has $200,000 in a savings account, earning 1% interest. He has $300,000 in a 401k invested in index funds. He owns his home, which is worth $600,000, but he still owes $400,000 on the mortgage. Sounds like he's in pretty good shape, right? But let's run the numbers assuming inflation averages 5% over the next 10 years, which is conservative given what we've seen recently. His $200,000 in savings will lose nearly half its purchasing power in 10 years. It'll still be $200,000 on paper, but it will only buy what about 120,000 buys today. His $300,000 in the market might grow to 500,000 nominally, but after inflation and taxes, his real purchasing power might only increase slightly. Meanwhile, his mortgage payment stays the same, but his property taxes, insurance, and maintenance costs all go up with inflation. His salary might get cost of living adjustments, but they'll lag behind actual inflation because companies always do that. So in 10 years, Mark is 55. He has the same nominal wealth, but significantly less purchasing power. He can't retire. He can't maintain his standard of living. He's working harder, but falling behind. Now, let's say Mark had taken 1% of his wealth per year, $5,000, and bought Bitcoin instead of leaving it in cash. Over the past decade, Bitcoin has returned an average of about 200% annually, though obviously past performance doesn't guarantee future results. But even if Bitcoin only returns 50% annually going forward, which is extremely conservative compared to historical performance, that $5,000 per year would grow to over $300,000 in 10 years. That's more than his entire savings account, dwarfed by a small allocation to Bitcoin. And here's the key point. Bitcoin's returns come from monetary appreciation, not from business performance or government promises. It's pure monetary technology. As more people realize that the fiat system is broken and Bitcoin is the solution, demand increases. And because supply is fixed, price increases. This is where it gets really interesting because we're not just talking about individual financial failure. We're talking about a systemic issue that's going to create pressure on every part of the economy. When millions of people suddenly have way less purchasing power than they expected, consumer spending drops. When consumer spending drops, businesses make less money. When businesses make less money, they hire fewer people and pay lower wages. It's a feedback loop. And at the same time, governments facing declining tax revenues and increasing costs will print even more money to cover their obligations, which makes inflation even worse. It's a vicious cycle that's nearly impossible to escape once it starts. Now, let's talk about the role of Bitcoin adoption because this is the thing that doesn't get enough attention. Every major financial institution is now involved in Bitcoin. BlackRock, the world's largest asset manager, launched a Bitcoin ETF. Fidelity, Vanguard, and every other major firm has followed suit. Corporations are adding Bitcoin to their balance sheets. Countries like El Salvador have made it legal tender. This isn't fringe anymore, this is mainstream. And here's what's going to happen. As more institutions adopt Bitcoin, more retail investors will follow. As more retail investors follow, more merchants will start accepting it. As more merchants accept it, the network effect accelerates. And remember, there are only 21 million Bitcoin. There are about 8 billion people on Earth. There are millions of millionaires. There are thousands of corporations and institutions with billions in cash. If even a tiny fraction of them want to own Bitcoin, there simply isn't enough to go around. That's what creates the wealth transfer. The people who get into Bitcoin early, while it's still relatively accessible, will see their purchasing power preserved and dramatically increased. The people who wait until every institution owns it and every government has adopted it will pay exponentially higher prices, if they can even get any at all. Now, let me address the elephant in the room. Bitcoin is volatile. Nobody denies that. It's gone from $69,000 to $16,000 and back to new all-time highs in the span of a few years. But here's the thing nobody tells you. Volatility is the price of admission for asymmetric upside. You can't have the potential for 100%, 500% returns without the risk of 50% drawdowns. The question you have to ask yourself is, what's the bigger risk? The risk that Bitcoin's price temporarily drops, or the risk that your cash savings lose 50% of their purchasing power over the next decade while you do nothing? Because here's the uncomfortable truth. Your cash is already volatile. It's just volatile in one direction, down. The dollar loses value every single year. It's guaranteed. Bitcoin might go down temporarily, but it has a track record of recovering and reaching new highs. The dollar has a track record of losing value forever. Now, let's add another layer. The timing. We're at a unique moment in history. The 2024 halving just happened. Institutional adoption is accelerating. The debt levels of governments around the world are at unprecedented levels. The money printing that happened during the pandemic is still working through the system. All of these factors are converging to create what might be the perfect setup for Bitcoin's next major move up. But unlike previous cycles, this time the institutional money is already positioned. When the price starts moving, it's not going to be retail investors driving it. It's going to be trillions of dollars from pension funds, endowments, corporations, and sovereign wealth funds. And once that money starts flowing, there's no turning back. So to recap where we are, cash savings are losing value to guaranteed inflation. Traditional investments are vulnerable to market crashes and systemic risks. Income is not keeping pace with the cost of living, and tens of millions of people are about to face a retirement crisis that makes the boomer prices look mild. Now, here's the kicker. The financial advice industry spent the last 40 years telling people that if they just followed the rules, everything would be fine. Save 10%, invest in index funds, diversify, rebalance annually. And for the top 20% of earners, that advice worked reasonably well. They had enough income to actually save 10%. They had employer matches on their 41. They had stock options and bonuses and real wage growth. But for the median person, the ones making $50,000, $60,000, $70,000 a year, working jobs that didn't have big raises or bonuses, the math never worked. They couldn't save enough to keep up with inflation. And instead of the industry saying, hey, the system's broken, we need a new monetary system, they just kept blaming individuals. You didn't save enough, you spent too much, you should have started earlier. It's classic victim blaming, and it obscures the real problem, which is that we built a financial system on a foundation of constantly debasing currency. Let's do one more scenario to make this concrete. Meet Jennifer. She's 38, works in healthcare, has $100,000 in savings. She rents because she can't afford to buy a home in her city. She's been watching her purchasing power decline for years. Every time she goes to the grocery store, prices are higher. Every time she fills up her gas tank, it costs more. Her rent just went up by 10%. Her salary increased by 3%. She's falling behind, and she knows it. Now imagine Jennifer takes 10% of her savings, $10,000, and buys Bitcoin. She dollar cost averages in over a year to avoid timing the market. She holds it for 5 years. Even if Bitcoin only returns 50% annually, which is conservative, that $10,000 becomes $76,000. If it returns 100% annually, which is closer to historical averages, that $10,000 becomes $320,000. Meanwhile, her cash savings continue to lose purchasing power. Which position would you rather be in? The one where your wealth is guaranteed to shrink, or the one where your wealth has the potential to grow exponentially? Here's the second comedic cutaway. Imagine a financial seminar from 20 years ago. Guy in a suit with a PowerPoint. If you just save 10% of your income and keep it in a high-yield savings account, you'll be fine. Cut to 22. Same guy, now older, same PowerPoint. So, about that savings account thing. Turns out inflation was higher than we thought, and the dollar lost 90% of its value. And also, you needed to save like 30%. And also, maybe you should have bought some Bitcoin. But other than that, solid plan. Now, to be fair, not everyone needs Bitcoin. If you're already wealthy enough that inflation doesn't really affect your lifestyle, if you have enough assets that you don't care about preserving purchasing power, then sure, ignore Bitcoin. But for the vast majority of people, the ones who are watching their hard-earned money lose value every year, Bitcoin isn't just an investment opportunity. It's a survival mechanism. So what does this mean for you? If you're someone who's been skeptical of Bitcoin, I get it. It sounds too good to be true. It seems like magic internet money. But here's the thing. The technology behind Bitcoin, the blockchain, is real. It's been running without interruption since 2009. It's never been hacked. It's processed trillions of dollars in transactions. And the monetary policy, the 21 million supply cap, the halving every 4 years, it's all working exactly as designed. This isn't speculation. It's code. And if you are someone who's already in this situation, watching your savings lose value, feeling like you're working harder but falling behind, I'm not going to sugarcoat it. Your options are limited if you stay in the traditional system. You can work more hours, you can cut expenses to the bone, you can hope that inflation magically goes away. But hoping isn't a strategy. And nothing in the incentive structure suggests inflation is going away. In fact, everything suggests it's going to get worse. So let's talk about 3 specific non-generic takeaways. First, if you have any cash savings beyond your emergency fund, you need to start slowly allocating some of it to Bitcoin. I'm not saying put everything in at once. That's reckless. But start with 1% of your net worth. Then maybe increase to 2%, then 5%. Treat it like insurance against currency debasement, because that's what it is. It's not a speculation. It's a hedge against a system that's designed to devalue your labor and your savings. Second, you need a long-term mindset. Bitcoin is volatile in the short term. It might drop 50% from where you buy it. But if you look at the 4-year cycles driven by the halving, the trend has been consistently up. Don't panic sell during a downturn. In fact, downturns are opportunities to buy more at better prices. This requires emotional discipline and the ability to ignore the noise. But if you can do that, the historical rewards have been extraordinary. Third, dollar cost average. Don't try to time the market. Nobody can consistently predict short-term price movements. Instead, set up automatic purchases of a fixed dollar amount every week or every month. Buy the same amount whether Bitcoin is up or down. This smooths out your average entry price and removes the emotional stress of trying to time the market. And over time, as Bitcoin's supply becomes scarcer and demand increases, those regular purchases will compound into significant wealth. Now, let me bring this full circle. People without Bitcoin are in big trouble because we built a global financial system that's designed to destroy purchasing power. We replaced sound money with fiat currency that can be printed at will. We incentivize debt and consumption over saving and production. We let governments and central banks debase the currency to pay for promises they couldn't keep. And we let the financial industry profit from all of it, collecting fees whether people succeeded or failed. The people who believed the promise, who worked hard and saved money, are the ones paying the price. But here's the thing, this was predictable. It was predicted, the incentives were clear. Governments wanted to spend more than they taxed. Central bankers wanted to manage the economy. Financial institutions wanted to maximize fees. And regular people had no leverage to fight back. So the system got rigged, and the people who are paying the price are the ones who had the least power to change it. And the final line is this. We're going to look back at this moment and wonder how so many people missed the biggest wealth transfer in history. Bitcoin adoption isn't a future possibility. It's happening right now. The train is leaving the station. The question is, are you on it?